I'm Leandra Lederman, and today I'm really pleased to host a guest speaker on the U.S. federal estate and gift tax.
I'm Goldburn Maynard. I'm a professor at the Kelley School of Business at Indiana University. It's time to break into tax.
Let's start with the basics. What is the estate tax and what is the gift tax?
So the estate and gift taxes are transfer taxes. So transfers to individuals, usually your family members, that's who you're likely to give gifts to, but it's not on all transfers. It's on transfers over a certain amount.
Can you give us more detail on what those amounts involve?
The estate and gift tax really is not meant to reach kind of everyday transfers. And so annually, the gift tax allows you to transfer to an individual, right, per individual, $16,000 without any taxes being due at all. And then in terms of the estate tax, again, not meant to reach everything. So you can leave an inheritance of up to $12.06 million tax-free.
So is that for an individual or for a married couple?
So that's for an individual. So an individual can pass on over $12 million. If you're a married couple, you can combine those and it'd be over $24 million.
And those are 2022 amounts, right?
Yeah. Mm-hmm.
And they're generally increased for inflation.
Exactly. So the estate tax exemption is just tagged to inflation, and every year it changes. The gift tax is a little weird. So yes, it's indexed to inflation, but in $1,000 increments. So it's $16,000 right now, but it'll take a couple years for it to get up to $17,000, right? So it will not go up by increments of 500. It only goes up in increments of $1,000.
So let's talk about what happens if an individual gives a large gift to one donee as a lifetime transfer. So say grandma wants to give grandson $20,000, and that's over the $16,000 limit for using those 2022 numbers. So grandma doesn't necessarily have to pay gift tax this year, right? What are her options?
So she will not likely have to pay gift taxes this year. So first, you would just say that first $16,000 is tax-free, not a problem at all. And then the $4,000 will depend on whether she gave gifts before. So the gift tax is also keeping track of that overall $12 million. And so that $4,000 will count against her $12 million. And so unlikely that she's used up that $12 million. So we would just subtract that $4,000 from the 12 million, and she will still have the remaining amount for future transfers.
Right, so it's a lifetime exemption. Is effectively the way the estate tax exemption works.
Yes, and so if we think back historically, the gift tax came after the estate tax, and the gift tax is really just around to prevent individuals from getting around the estate tax. So when the estate tax was first enacted, the easiest way to get around the estate tax is to just give away all your property while you're alive. And so the gift tax came into being so the two of them could be integrated. And so you just couldn't get around the estate tax by giving away all your property during life.
And there are also other exemptions from both the gift and the estate tax, right? So some transfers are not even going to be in the tax base as taxable gifts or as part of the taxable estate.
Exactly. And so generally, we are going to exclude transfers to charities. So transfers to qualifying charities are generally not going to be picked up by the estate or gift tax. Also, transfers between spouses are not going to be captured by the estate tax. Also, when we're thinking about the gift tax, there are also some other little things. And so, for example, to the extent that you pay tuition expenses directly to a school or institution, those are not going to be included either. Also, to the extent that you pay a medical bill on behalf of someone, that will not be included either.
You mentioned that the gift tax was enacted to backstop the estate tax. What was the purpose of the estate tax itself?
There's sometimes some disagreements about this. And there tend to be two camps. And so one camp says, well, the estate tax is really about breaking down concentrations of wealth. And so we're worried that as wealth passes down through the generations, you're just going to end up having wealth in fewer and fewer hands. And so some individuals say that's the purpose. Other individuals say that it's about equality of opportunity. That is, to the extent that anyone is born in this country, they should generally have an equal start. And so the estate tax is meant to help with that. Of course, there is the third, right? In that any tax instrument, of course, brings in revenue. And so that's a part of it as well.
Does the estate and gift tax raise a lot of revenue?
No, it does not. At no point in history has the estate tax accounted for more than a couple percent of the total revenue that the federal government collects.
And the estate tax actually hits only a small percentage of estates, right? So what percent approximately does it apply to currently?
Way under 1%. And so I think right now the figures are at around 0.2% of all estates get taxed.
So the estate tax is notoriously unpopular. Why do you think that is?
So I think there are a couple reasons. So one reason is just that there has been a decades-long active campaign by individuals who are wealthy against the estate tax. And so the idea is to get Americans on board on repealing the estate tax. So there's been a lot of money spent in that, so I don't want to underestimate that effect. There are other things as well. There is this sense that the estate tax is this very insensitive levy wherein the government is coming in at a point where families are dealing with grief and asking for payments to be made. Sometimes payments that families cannot make right away, right? They may need to take out loans, et cetera, to pay these taxes. And so to the extent that it's seen as a death tax, it's seen as a particularly insensitive kind of tax.
When the heirs are taking out loans, that's probably because they're inheriting real estate or maybe stocks and bonds or a family business, something like that, right?
Yes. And so know that you're paying taxes on the gross estate. So if you have a big tax bill, that's because the gross estate was large, right? There was a lot of wealth in the gross estate. Unfortunately, as we know, not all property or business interests are very liquid. And so sometimes families either have to take out loans or liquidate some part of the property in order to pay the estate tax. On the other hand, we want to keep in mind that a lot of policy experts feel like the estate tax is a good levy in that it's taken into account someone's entire life. So where the income tax can sometimes be unfair because sometimes you may have a really good year followed by a bad year, the estate tax at least is taken into account someone's entire life and the wealth that they built over the course of their life.
So you did estate tax work at the IRS. Can you tell us a little bit about that?
Yes. And so the way that I actually learned the estate tax was because I went to work for the IRS. So I was an estate tax attorney, and technically the estate tax is under small business and self-employed. And so the estate tax is a small program that is completely separate from the income tax program. I don't know the exact numbers now, but traditionally there have only been around 200 estate tax attorneys. And those estate tax attorneys are the ones who manually decide which estate tax returns are gonna be audited. And then they're the ones who actually execute that audit.
Wow, that's very different from how the IRS examines income tax returns, isn't it?
Yes, very different deal in the sense of the experts who are even working on the audits. On the income tax side of things, you have what are called revenue agents, and those tend to be accountants, and they tend to be the individuals who run the audits. Also, because you have so many tax returns, you also have computer programs involved in selecting who is going to be audited. On the estate tax side of things, you have estate tax attorneys. And so you have attorneys who are the ones who actually once a month or every couple months actually sift through individual tax returns and decide which ones are going to be audited, and then they execute the audit.
So tell us more about what an estate tax audit is like. Are you doing it at the IRS office? Are you meeting with the heirs? How does that work?
I worked in California, in Northern California. And so my experience may have been a little bit different. So depending on where you work in the country and how many wealthy individuals there are, it could be that you're auditing returns from other parts of the country. In Northern California, there's a lot of wealth. So it turned out that a lot of the audits were for other California individuals. So a lot of these, of course, happen in the office. The first thing that you're doing is looking at the return and asking for a bunch of documents. And so the other thing that may be a little bit different is that you have wealthier individuals. And so you're not dealing with them. You're dealing with their attorneys for the most part. So yes, from the office, you ask for all of these documents and you review them. But oftentimes you also want to have in-person meetings, or you may want to in-person look at some of the assets, right? You want to double check to see if some of these values are correct. So there is this mixture of a lot of office work, but some field work as well in terms of meetings and looking at assets.
That is so interesting.
Very different. And also there's this third part that comes in that a lot of income tax individuals don't deal with, and that is appraisers. And so because the estate tax is all based on the value of your estate, it matters how much the assets are worth. And so a lot of the back and forth between estate tax attorneys and the estate are on the value of assets. And so appraisers play a huge role in that.
So did you often meet with the appraisers, or were you just reading their reports?
I was reading their reports, challenging their reports, sometimes meeting with them. What you quickly find out is that valuation is very much an art. There are scientific aspects in there. And so even as a non-expert in appraisal, you learn which parts you can ask questions about. And little decisions can make a big difference in value. The IRS has its own appraisers. However, the IRS is actually a huge organization. And so the appraisers are not working for the same people the estate tax attorneys are working for. It's a separate unit. And so you have to refer out your case. And sometimes it may take quite a while for that case to be worked on. And you may have to make decisions based on how comfortable you're willing for this case to last for a long time. And so, yes, the IRS has its own appraisers, especially when it comes to things like houses and business. There's a completely separate process when it comes to art.
That sounds really interesting. How does the art appraisal process work?
So the art appraisal process is one of the most fascinating. And so what the IRS does is that they convene what is called an art appraisal panel. And so this is a group of curators, museum experts, et cetera, from across the country who meet only twice a year. And they consider any appraisals that were referred to them. So they take a look at the art and determine how they think that it can be valued. Note that this is an independent group, not affiliated with the IRS. And so it can go in both directions. Sometimes they think that, well, the IRS is wrong. They're too high on their valuation. Sometimes they think that the estate is too low. So they really are independent and well respected. And so often when the art panel comes back with a value, the estate will agree to it because that's how much they respect the art panel. I was an estate tax attorney. I would try to come up independently in what I thought was a reasonable value for an asset. And the estate may disagree with that value. And often we're trying to figure out where the actual value is. The problem with appraisals is that there's always a range. And so the IRS doesn't come in with a number. Rather, they may disagree on where in the range the number falls. They may think perhaps the estate is lowballing that number and they think it needs to come up a bit higher. Yeah.
So what was the hardest to value asset that you saw in your time at the IRS?
So generally houses and buildings tend to be pretty easy. Art, you have the art panel, and so that tends to be okay. Businesses are always the most difficult thing because there's so many different things going on with a business. And then you also have to consider, especially with these closely held businesses, how would that business perhaps sell on the open market? And so generally businesses, especially businesses in a very kind of niche area. So let's say it was a steel manufacturer, right? That's really specific. And so you need to find out a lot more about the steel industry. And so businesses tend to be by far the most difficult thing to value.
You know, I wrote an essay, I think it was last year, on, I think it's titled Valuation as a Challenge for Tax Administration.
It's huge for the wealth tax as well.
Yeah. So doing estate tax work, you've probably read a lot of wills. Is there anything that you want to comment on about that?
Yes, people hold grudges and they don't let them go. It's fascinating. You'll have these very wealthy people and then some very kind of petty clauses in their wills. There's one that I remember, it was so petty. So it was something like, and to my cousin Ira, I will always remember that time you hit me with a rock when we were 10. You reap what you sow, and I leave you nothing in this will.
Yeah, and this is probably like 70 years later or something like that.
Exactly. Yeah, not at all close to the time. Yeah.
This has been an overview of the U.S. federal estate and gift tax. As always, please keep in mind, nothing from Break Into Tax is legal advice. Please consult your own tax advisor if you have tax or legal questions.
Thank you so much for joining us as we break into tax.
Don't forget to like this video, share it with your friends, subscribe to the Break Into Tax YouTube channel, and turn on notifications so you don't miss a single video.